Hey there, are you someone in CF final who is still finding it difficult to decode the logic for a foreign currency bank balance in relation to Ind AS 7? Don't worry too much about it. I've got this one covered for you, and here's a full disclosure. So let's start off with an example to understand this, and let's break it into segments to understand it better. Let's say entity A has a bank balance in US often amounting to $100. Let's say the closing balance in relation to the same after the interest gets accumulated on it as at the year end becomes $110. Let's say the opening exchange rate is rupees 60 per dollar, while the closing exchange rate as at March 31 is rupees 70 per dollar. So in the books of accounts on April 1, the entity would show $100 into rupees 60 per dollar, 6,000 as the opening balance in books of accounts. In relation to the closing balance, the entity would show the following in the books of accounts: $110 into rupees 70 per dollar. So rupees 7,700 would be shown in the books of accounts as closing balance. But how do we present this in the cash flow statement? So this is where we have to apply a bit of our mind, and I'm going to be doing that for you. So the 6,000 rupees of opening balance, let's just retain that as it is, and let's retain the 7,700 as it is. So there is a variance of rupees 1,700 from 6,000 to 7,700. But let's bridge this 1,700 into two components. One, the interest component. Second, the forex component. So what is the interest component? Guys, as I told you in the example, $10 of interest got accumulated as at the year end. And the exchange rate at which the bank would pay to us would be rupees 70, because the interest would get accumulated as at the year end and would be paid to us as at the year end at the rate of rupees 70 per dollar. So the amount that would be accumulated as interest, if we had to translate it in rupees, would be $10 into rupees 70 per dollar, which is rupees 700. So if I have to give you a perspective, the 1,700 would be bridged into two components: rupees 700 of interest and 1,000 the balancing figure. So how do we show this in the cash flow statement, guys? So first we will write the gross variance of 1,700, which is the variance from your 6,000 to 7,700. So 1,700 minus your 1,000, which is the forex gain, will be reduced. So why is the forex gain reduced in the cash flow statement, guys? This is reduced because the forex gain is not a cash flow statement item. So you'll reduce it. So basically the net amount of rupees 700, which is the interest, will only be disclosed in the cash flow statement. But you guys would be having a doubt here. If we do 6,000 plus 700, it would result only in 6,700. So this is why we prepare a reconciliation statement from rupees 6,700 to 7,700 to tie the numbers back to the financial statements, because the closing number in cash flow statement would be 6,700, but the closing number in the balance sheet would be rupees 7,700. So we prepare a reconciliation saying that the closing number as per our cash flow statement is rupees 6,700 plus a forex gain of 1,000, which would sum it up and lead it to a number of rupees 7,700. I hope you found this insightful. So do keep learning, do keep growing, and do share this, and do hit that subscribe button if you found this useful. Thank you so much. Cheers.